Welcome everyone. This is What's in Store for New York City Real Estate 2020 and beyond. I'm John Walkup with UrbanDigs, and today I'm joined by Jonathan Miller, who is the eponymous founder-in-chief of Miller Samuel. It's a real estate appraisal firm that you are well aware of, and he's also the master of the universe. That's a sub job, you know.
And he's always right.
Side gig he's
Absolutely.
got. And the other panelist today we have is Noah Rosenblatt. He's my partner at UrbanDigs. He's the CEO and founder, and he knows a lot of stuff too. So hopefully we're gonna get some good discussions. Just a quick note: we had over 500 people register for this webinar, which is fantastic, and we solicited questions. We got over 200 questions. We tried to whittle all those down into sort of bigger buckets to try to answer as many of them as we can. So sorry, we're not going to get very granular. You know, if you asked about a West 88th Street walk-up studio and what the demand for that is, I'm not sure we're going to have time for that today. But hopefully we're going to have most of the answers for you.
I prepped for it.
We did prep for it. That's what I'm saying. I'm sure we'll get to that one. But we are recording this. We're going to have this on YouTube after the fact with some graphics. So it'll be a little more, fancy. And with that, I suggest we get right into it. So Jonathan, the first question is for you. Agents are tasked with pricing properties in today's market, which many consider a down market. Can you break down how agents should approach the pricing strategy? And specifically, can you discuss how you're selecting comps and making adjustments to those comps?
Sure. So the first thing is I'm gonna sort of talk about what you shouldn't do, and then I'll flip it into what you should do. Because the reason why I say that is because quite often when we interact with a broker, like a listing broker, and we're it's been sold and the bank hires us and we go on the property, quite often we're given a sort of an Excel spreadsheet, and let's just say the property was listed for $1.1 million and it's under contract for $1 million. And so what we do is we get a spreadsheet that if you sort it by price, the lowest number is 1 million and the highest number is 10 million. And
it's quite a range.
It's not useful, and actually it's sort of a red flag. Like, you're really worried about this price. It's not solid, and it's not something usable for the appraiser, especially if you have an appraiser that doesn't know doesn't know the market. So the first thing we do is, look at the submarket, and what I mean by that is this buyer, where would they have looked? What type of buildings? What location would they have looked at? Chances are it's going to be in the same neighborhood. And, we try to, it's really common sense. There's no secret. It's like, if you're in a walk-up and it's a 4th floor walk-up, I had to get the walk-up thing in, John.
I appreciate that.
Yeah, just
I'm working on changing my last name to Penthouse because
sorry.
It makes it easier.
I just love saying your last name. But the idea is, what would be competitive. It is amazing to me. I do a lot of court testimony, and information that's presented, the lawyers will say, well, here are the comps, as if a sales transaction is a comp, but really it has to be comparable. And it's just common sense. So if you're looking at a 4th floor walk up, you really don't want to look at, elevator buildings if you can help it. And if you're looking at an elevator building, it would, hopefully be of the same age era, the same location.
So keep it as absolutely relevant as possible in terms of your target unit and your comps.
It's just common sense. You're looking at the property, you're standing outside in front of it, you're looking at the property. Imagine if, you took your client to 6 other properties. Do they all look similar to this just from the external before you even get into the internal? Like, is there something similar about it? The street, the location, the frontage, all that sort of thing. It's just common sense. The problem that we have right now, and it's actually a very serious problem, is that there aren't a lot of comps because we're coming out of a global pandemic. Hopefully we're coming out of it over the next year. And, transaction volume is way down in Manhattan specifically. And so as a result, you don't have a lot of selections. So it makes it even more challenging. And sometimes, we try to present 5 to 6 comps on a grid in the appraisals that we do. But oftentimes only maybe 2 of them are truly comparable. and the rest are there simply because of regulatory reasons that we have to present more than 2 comps.
Right.
It's really come down to that. One other thing about selecting, and this isn't exactly what you're asking, but I've never been known for directly answering questions, is that what's really interesting right now is that because the market is starting up and there's a lot more contract, there's a lot of contract activity relative in terms of what's relevant, simply because we had a dearth of closing or contract activity, during the pandemic, that we're gridding, presenting a lot of, competitive listings and contracts. Even if we don't know the price, we're saying, well, the average discount in this market is X%, and sort of putting it in because it's more important to have a similar property type, that you're comparing to. So really, contracts, closings, and listings are okay, just knowing that banks have to have at least 3 closed sales. The appraisers have to present them that way. We just don't pay a lot of attention to them. We really focus on the contracts and listings that are, we talk to the brokers, get an idea what's going on behind them.
Hey, Jonathan, may I ask you a quick question?
Sure.
You mentioned a key point. You mentioned low volume, and that's like kind of a thesis for a lot of my talk. I'm going to be answering questions to today, is that we're in this low volume environment, which means agents have a sacrifice to make. Do they focus on recency or do they focus on relevancy, right? Because the relevancy might not be there, so they have to sacrifice recency to get that relevancy, which means I'm basically saying you might have to go back to 10 months or a year ago or something a little further back that's more relevant. You have restrictions in your systems, is that correct? Okay.
Yeah, so they're more like, if you ever saw those Johnny Depp pirate movies, they're guidelines, right? That's like the pirate, because I bring that up because Saturday is Talk Like a Pirate Day, I believe. Yeah, Saturday is Talk Like a Pirate Day. So for everybody that celebrates that, that was the pirate reference. Anyway.
I learned something new about you today, Jonathan.
Yeah. It's a long story, but I've been celebrating it every year.
But it almost sounds, Jonathan, it almost sounds like agents need to prepare 2 sets of comps. One is sort of for pricing the unit in today's market. And the second is, all right, what are the comps that the banks are actually going to look at? And, what price is this going to possibly clear at? If it has to go for a lower price, where are we looking at in terms of?
Yeah, so you both bring up a really excellent way to think of it, is sort of, the nitty gritty raw current, but then more similar, sort of apartment or building profiles that might be pre-COVID. But think of the pre-COVID sales in a down market as almost like presenting a listing. In other words, the market has set lower, since COVID, at least as of this moment. Here's something that sold for $1.1 million. I'm in contract for $1 million. It seems to be consistent or whatever. Like the idea is, the way I look at valuing something is really comes down to, if you went to a coffee shop and you were sitting with your best friend who was thinking about buying a house, and you were telling them specifically why you thought it was worth what it's worth. It's not going to be like you're going to grid 6 sales and you're going to say, it's that you're going to talk them through, and you're going to talk about current activity, but then you're going to say, and, in the neighborhood before COVID, before we had all this inventory, this was the price structure, or this is what they were going for. And that's really what it comes down to. You shouldn't have too much problem.
All right. And if I could, thank you, Jonathan. That's very informative. I'd like to shift gears a little bit, and not necessarily in 180 degrees, but it's similar to what you're talking about in terms of opacity in the market, and similar to what Noah's talking about in low volume. And so, Noah, the next question's for you, and that's, let's talk about the investor sphere now and the investor units. Manhattan specifically, is there a value play here, or is it a falling knife in terms of the investors?
Yeah, that's a pretty frequent question. Value play, I tend to look at it in 2 categories. You got the investors, and then you got the residential purchasers, right? In terms of the residential purchasers, it's simple. You want to just buy low and sell high, right? It doesn't get too much crazier than that.
Hold on, I'm going to write that down.
We'll talk about that in a second, right? But when it comes to investors, I think about things like cap rates. I think about things like rental prices. I think about things like rental inventory. And when I look at what's going on, yes, sales prices have come down and we have shifted and reset to a different normal, but so has rental prices and so has the rental market. And I think we'll talk about a little bit of that today. And the rental market, maybe even a little more so. I mean, the rental market's under a lot of pressure right now, a lot of pressure. So I think, like, if you think about the slope of the reset, I think the rental market's undergoing a little bit more of a sharper slope. The sales market had a sharp slope, but it's kind of come back and stabilized, albeit at a lower level. So again, if you think about these two equations, you got sales prices and you got rental prices, both of them are falling at the same time in tandem. You're not getting that cap rate push that an investor's really looking for. An investor's looking for, falling sales prices with the rental, rate staying similar or rising. That's what they're looking for. So like, I was originally thinking that, back in March and April, we're finally going to get into a market where cap rates mean something. And I think we're in that process, but I don't think it's played out yet. I mean, if it was a baseball game, I would say it's probably the third or fourth inning, only because of the pressures on the rental market. So from an investor standpoint, there's some price discovery yet to come that will show, again, rental yields rising when the sales prices are hopefully starting to normalize. Now, the thing is that the rental market moves much faster than the sales market. So now, if we were to strategize or war game this a little bit, it makes things tricky. From an investor standpoint, you kind of have to purchase it while it's going down. Because if you wait as an investor and you wait for the rental market to stop falling, to stabilize, to come back, you're going to find those value deals much, much, much harder to find. So you kind of have to anticipate, and you kind of have to buy on the way down, hopefully after we've fallen a lot from an investment standpoint. From a residential standpoint, we're in reset mode. I mean, from just a typical buyer, right? It's ugly, it's painful, it's mysterious, there's no volume. We're all sitting here trying to find out information. Insights and content is like gold right now, but there's no volume. And that's where the problem lies. That's the Achilles heel of the buyer. The buyer's looking for a value. To them, it's 15 or 20% off. They find a great property, and it just so happens that seller's willing to give 5 to 10% off. And a lot of the market metrics are showing that we're down about 5 to 10% in the broader market, the 2 million of the market. So the buyer's sitting here saying, what do I do, right? And I need to get 15, 20% to feel like I'm getting a value, that value play. That's the trick. That's the Achilles heel, is finding that good property where the seller's desperate and willing to move quickly, and they're willing to kind of sacrifice price, and you just happen to be like one of the buyers that takes advantage of that. Mm-hmm. The problem is those are fewer and far between. So from a value play, in terms of residential, quite frankly, I think it was better if you bought in April and May and June when we were in shutdown, because you probably had a better chance of getting that seller to hit a bid.
Right. And what about the sorry, go ahead, Jonathan.
I was just going to throw in a thing, what's a little bit different too in this environment that you really nicely presented is that we don't really have a sort of endpoint that we can kind of all agree on in terms of how this plays out, because in my view, nothing really normalizes until there's a vaccine, truly, because we're going to have this ebb and flow. And so that's uncertainty, and brings uncertainty, which is a wildly overused word, but it's another layer of uncertainty, I guess, that you wouldn't probably typically have.
Yeah, and I think, and just to interrupt, I feel like that's one of the main things that's putting this sort of abbreviation on today's market, is we have layer upon layer of uncertainty, where usually it's like, okay, well, it's the equity markets that are the source of uncertainty, or it's a political year. Now we have equity markets, we have the foreign currency markets, we have an election, we have COVID, we have second wave fears, and we just have a number of things that are piled onto each other. Yeah. Which brings me back to you, Noah. So the whole falling knife, is it a falling knife? Is it going to cut your hand before you catch it?
The falling knife. I forgot to answer that question. I wasn't avoiding it. So I mean, you might get nicked. You know what I'm saying? You're going to get nicked. Like the knife is falling, you're going to get, but the knife is falling from a much lower level, John. You're not going to just go and pick up the knife and start going on the aggressive and making all these amazing plays. You know what I'm saying? Like if you're gonna play, you gotta get cut a little bit. You gotta get a little bit of blood. And the thing is that knife is falling from a much lower level. When I look at this market right now, the words priced in like resonate to me. Like the COVID, like you said, all those clouds and layers of uncertainty that are hard to fly the plane through the storm and you can't see where the hell you're going. That's causing buyers to pause. Right. But it's priced in. So buyers are bidding with all of these uncertainties. Maybe not so much the election because we don't know what might happen after the election and stuff like that. That's still yet to kind of play out. But if the knife falls further, it's going to be from a lower level. So you'll get nicked. It's not going to saw your hand off.
Right. I would like to change metaphor so we don't get this video flagged and had some strange tags on this. But so
blood in the streets.
Yes, exactly. But let me take that and run with it. And Jonathan, let me ask about the elephant in the room, the New York City exodus, and everyone's talking about it. Is it real? I mean, you have a lot of visibility into the suburban markets, Miami. What's happening in these markets, and are people leaving the New York markets for good, temporary? What's happening?
So first of all, if you write anything about anything to do with migration patterns, if you put in the words exodus or the phrase fleeing the city or flying away, you'll get a lot of reads, right? Those are sort of, the buzzwords of this phenomenon. And I think it's absolutely, there's outbound migration. The numbers in March and April, about 420,000 people moved out of the city, not necessarily permanently. And so, you ask yourself, we have, I produce these contract reports for Element every month, and you can see all the suburban markets surrounding the city are seeing a large uptick in contracts signed each month. Initially it was over 100% year over year in terms of up, and Brooklyn off the charts. The story really shouldn't be urban to suburban. It really should be Manhattan to suburban, is the way I think you should think of it. I mean, it's not that people aren't leaving from other parts of the city, but what you're also seeing is a tremendous amount of interborough migration between Manhattan and the outer boroughs, both ways. It's just that the outbound is larger than the inbound. The other thing that's sort of fueling the narrative without the data is that the optics of Manhattan right now and every news program are scanning Times Square and all the boarded up storefronts and all that. But then if you go to the Upper East Side, I was there a few weeks ago, and everybody's wearing a mask and sidewalks are vibrant, people are eating outside, and it feels not normal, but quasi-normal. So there's a massive sort of optics problem with the way the city is being presented. We are seeing some of that in, I cover about 36 different housing markets around the country, and we are seeing, an urban to suburban sort of pattern, but it seems more extreme in New York. And I think the reason it was more extreme in New York initially is because we misunderstood what the word density meant, and people were fleeing for safety from density, because density meant higher probability of getting COVID. When we now look back at it, we know that it wasn't density, it was wealth and mobility. That the reason why 40% of Manhattan literally moved out is because it's the wealthiest borough and there's much more mobility. They can go, whether with friends, second homes, rentals, buy somewhere else, whatever. They have a lot more options. So I think that that's been a bit of an overcorrection or overstatement about the surging suburbs. And, listen, if the suburban markets, they're having five-way bidding wars, how sustainable is that in over the next year or two? I don't think it's that sustainable. So I'm, if you read everything that's been talked about the city, there's, at the end of this month, we're going to have 5 people left, and it's really overkill. I think we're probably talking about 50,000 people will move out. One last point about this is when you think about this, like how this plays out, after presumably, hopefully, fingers crossed, that there is a vaccine and it's widely adopted and this nightmare is at least manageable or goes away, hopefully, we still have Zoom, what we're doing right now. And that has, like I like to say, has expanded the tether between work and home to an infinite. So now people are looking at the Hamptons as a co-primary type housing market rather than just a second home market. So the city does have challenges and ahead of it. It's, you know, make no mistake, but it's not the death knell, I think, that that has been described.
Well, it's interesting. So I live on the Upper East Side. I was out last night out in Carl Schurz Park, and you know, it's one of those days where the weather in the city was just absolutely amazing. And it's, if you're ever going to come back to the city from wherever you're hiding out, yesterday was the day to do it because there's just beautiful weather and just people were out strolling around, masks on. It was great. I also
think about the people that are living in the suburbs that are now being called back to work. They're coming into Midtown, right? And it's empty, and that's Manhattan.
Exactly. I was also in Prospect Heights, and I was on Vanderbilt Avenue, and this is yesterday afternoon, and there's tons of people out, bikers, people getting coffee, getting ice cream with their kids. It was quite a scene. So, and I'm wondering, you know, you talk about the exodus, this interborough thing. It's as if the waters of the East River have parted, and Manhattanites have taken the city bike across and have discovered Brooklyn and are bidding it up. And you mentioned the wealth and mobility of Manhattan, and I'm curious how much of this is just a price point thing in terms of the Manhattan market price points versus the Brooklyn market price points in general.
Well, I think price point is a big thing, and one of the I think the way that I sort of have rationalized this whole situation is about 2 or 3 years ago, I felt like the city had crossed some sort of affordability threshold, and that we were like 2 or 3 years too far in, that it was just too expensive. And then what happened was, all of a sudden you take away all the cool things that make living in the city so fun, like, you know, cultural, you know, ball games, you know, plays and shows and outdoor dining and indoor dining and all the things that make Manhattan so awesome. All of a sudden they're not accessible, or it's much more difficult, or you have to take public transportation and you're worried about that. So all of a sudden, you know, putting up with, like, you know, a couple with 2 kids in a 2-bedroom and they're both working, all of a sudden is unsustainable, you know, and no end in sight. And so you have this sort of almost panic buying, you know, outside of the city. And one last point about this, and what Noah was alluding to earlier, with the rental market being hit harder than the purchase market, who are the people that are fueling all the purchases in the outlying suburbs? It's mostly renters. It's a lot of first-time buyers is fueling it. That's why the rental market, and also, as Noah said, it's much more immediate. You know, the impact to the rental market is a much quicker, you know, it makes a much quicker reaction to changes of conditions. Right. But, you know, it's not so much the sales market. I'm not saying it's not, but it's the rental market by far, because after all, Manhattan is 75% rental. New York City is 2/3 rental.
Yeah. Right. Hey, John, I just want to make a quick point about the exodus before you move on. You know, we're in it. We're still in it. It's 6 months ago this thing happened. People, sometimes we forget, like, kind of where we are. But if you just back 100-year global viral pandemic, none of us really know what the hell we were doing back then. And we're still in it. It's 6 months. New York City was a hotspot. I mean, it's come a long way back. It's quite amazing how it's come back. But it was a hotspot. So that type of behavioral change that it integrated into people that lived through it, it's going to take some time to reverse that. And I think what Jonathan said is true. Is, you know, you're whipsawed to one direction. And I think at the end of the day, when you look back at this period in time, you're going to say, wow, we did whipsaw in one direction and we kind of swung back.
A little bit of an overreaction or correction.
Yeah, I am aware of commercial, Jonathan. I mean, you mentioned this whole remote
thing. We're not talking about commercial.
I know, but this whole remote thing, commercial, I don't know. I think that's in a league of its own.
Right. Well, let's go back to the sales market. Let's just focus on that, and then we'll shift to rental in a second. But Noah, talking about the sales market, let's talk about price discovery. Can you give us some insights into where listing discounts are right now and what that market looks like?
All right, COVID listing discounts. Yeah, so I did a bunch of data digging in the last couple of days, and I came up with something. I was trying to figure out this, John, because I know a lot of people ask this question, what is the COVID listing discount? I figured, how do you define that? right? And I was like trying to think in my head, how do you define it? So I came up with two simple parameters. I wanted to keep it recent. So I said, all right, I'm only going to include sales since the reopen, John.
Okay, that was June 22nd.
Right. So I think June 23rd and on. So
right.
Sales June. So we're almost 3 months, almost, right? Okay. I also looked at the contract signs of all those sales. I looked at when they signed into contract, and anything that was signed into contract before the shutdown in March.
March 23rd. Okay.
I took out.
Gotcha.
Okay. So this data set is sales after the reopen for deals signed after the shutdown. That's how I define COVID. Okay. So when I do that, I get some interesting data. So let's just go by price point. Okay. When I look at under 1 million, and if you're agents, you may want to write this down, and I'll have a chart I could throw up on this on the recording. Under $1 million, 7.9%. $1 to $2 million, 9.6%. $2 to $3 million, 11.6%. $3 to $5 million sector, 13.9%. 5 to 10 million sector, 20.3%. This is listing discount from original ask, by the way, original. And this is what's surprising and didn't really make sense, but it is because there's not many of them. 10 million plus, 9.5%. There's very few of those. Yeah. So now when I change it and I look at property type, co-ops, the whole co-op market, right? 8%. When I look at the condo market, 11%. Okay?
Mm-hmm.
Now let's take a look at resales and new developments. Resales and new developments. When I look at resales, 9.4%. When I look at new developments, 12.4%. Okay. Now the thing with new developments is, as Jonathan could probably talk about, is we're not tracking concessions, and that data is also hard to. That's a tough sector to follow. But I mean, 12.4%. You imagine that. All right, that's your negotiability pricing. Then you probably get some X% on top of that, and concessions maybe you're close to 20% at the end of the day.
Right. And did you parse through neighborhoods as well?
I parsed through main neighborhoods, because I don't have time to go through 36 different sub-neighborhoods. So here's what I found. Let's start with the best and go to the worst. Upper Manhattan, 6.2%, hanging in there. Upper West Side, second best, 7.9%, COVID discount. Upper East Side, 9.7%. Midtown, 10.3%. Downtown, 11.3%. So excluding the $5 to $10 million sector, which was at 20%, everything's kind of in a range of like 7 to 12%.
Right. But it also sounds to me, Noah, and correct me if I'm wrong, but you could kind of read through the lines here to find where the deals are. So it sounds like Midtown, downtown, expensive condos are right now. That's your best bet in terms of for finding the value. Whereas the Upper East Side, Upper West Side co-ops under 2 million seem to be holding their own.
Yeah. And I mean, it's what the data, yeah, exactly. And you got to just think about this. You got to think about, all right, you got to assume 10 to 15% of these trades might be outliers as well. So when you look at that median of 7 to 12%, you got your few that are 15, 20%. You got your few that are 3 to 5%, the meat in the middle, 7 to 12. And that's what I was mentioning is it's hard to come by those value plays of down 20%. Everyone's thinking 20, 25%. The broader data doesn't support it.
Right. And Jonathan, does this sort of agree with what you're seeing? Because I understand you get a lot of it. You get some early looks into price action before the sales close. I'm curious how this meshes with what you're seeing.
Yeah. Well, so first of all, yes, it does. And then secondly, the pattern he's showing by price point is lower discounts on lower prices, as you move through the price strata. And he's looking at original listing discount. What's interesting though, I would argue that this shouldn't be called a COVID discount, because this is what I think of as a COVID. So what you're saying is, this is really what you're saying is this is from what's asking right now, what are these things trading for based on that list price? So that's the spread, right? When I think of the COVID discount, and just this is the way my head works, I think, if I had a million or 1,000,001 sale in March, it went to contract in March, versus 1,000,001, the same unit went to contract in August for 1 million, the COVID discount is 10%, like the same unit. Like it's more the value, not the sort of relationship between ask and
Right, I understand. You're looking pre-COVID versus COVID to figure out what that spread differential.
Right. When I hear the term COVID discount, that's the way I think of it. I think of, like, I agree with everything you're saying. I just wouldn't call it COVID discount. It's really listing discount during COVID.
Yeah.
You know what I mean?
Yeah, that's a better way of saying it. Yeah.
Yeah.
But the overall point is that it's, again, all the data does not support it unless you go find those outliers, those one here, the one there that you see is down 20% and down 25% from ask, and that fits in with the narrative with that seller had to sell.
Right.
Right. And also too, I would say that a lot of people, so early on, and I'm sure you felt the same way when there was no contract data, like there was nothing going on. I mean, I'm exaggerating, obviously. There was something going on, but it was very nominal. You know, all we had was anecdotal, right? And, you know, I was saying, you know, you get someone say, well, you know, I know this one sale that had a 27% discount, but then I know this other sale that had no discount, you know, but the people that are looking at the 27 maybe saw a 15 and a 12, and they're saying, you know, it's like 12 to 27%, it's 20% off, but it's anecdotal. Those are like 3 transactions against, you know, what other data there was. And I always found it somewhere in the 5 to 10 overall range, closer to sort of, to pick a number, be around 7.
Right.
And that's kind of what this data showed.
Yeah, let me just interject here. The Q&A is lighting up. I guess everyone would love a copy of this. So what we're going to do is Noah prepared some slides, I believe, and we're just going to email these out. If you registered, we got your email. We're going to blast these out after that. They'll also be on the video for this once we publish it on YouTube. So if you're asking about it, which I've already got about 50 questions, it's coming. After this, we'll send it out. I just want to stick on sales for a second. And Noah, could you talk about some of the listings that are going into contract right now? What are those listings?
Right, exactly. So this was another one of those questions, was the makeup of, all right, contract signed during COVID. I'm not going to say COVID contract signed. So this was interesting because you got all these different sectors. Now think about this, right? There was about 2,200 deals signed since March 23rd. 2,200. Okay, forget about where we should be, probably 7,000, 8,000 or something. But we had 2,200, so 2,200 COVID deals. Now, if I break that down, it's about 660 during the shutdown, and it's about 1,560 or so during the reopen. Okay. Now, out of all those 2,200, just so you guys know, this is interesting to grasp. Only 430 of those closed, John. So you still got 1,700 COVID deals to go through the pipeline. So I analyzed all of the contracts that were signed since the reopen. Again, I wanted to keep it recent. So since the reopen, I averaged all the contracts signed, so about 1,560. And here's what I found. Under $1 million, 49% of them. 49% of these contracts were signed were under $1 million. 27.8%, 1 to 2 million. 1 to 2 million sector, 28%, basically. So between the under $1 million sector and the 1 to 2 million sector, call it under 2 million, 77% of total contracts signed were under 2 million. Okay. When I go to the 2 to 3 million sector, that was 12% contract signed. And then when I go to 3 to 5 million, it was 7%, and 5 to 10 million, it's 4%. The bottom line is 89% of all contracts signed since the reopen are under $3 million. Okay. So now I broke this down by bed count, Okay. Studios comprise 12%. 1 bedrooms comprise 39%. 2 bedrooms comprise 30%. And 3 bedrooms comprise 20%. So 1 bedrooms or under is half the inventory. Half the contract signs are 1 bedroom under. If we go up to 2 bedrooms and under, that comprises 82% of the contract signed, okay? When I look at new development resale, 87.5% of contracts signed were resale. 12.5% were new development. And finally, I have by building type, when I look at co-op, condo, townhouse, 57.5% of the contract signed since the reopen have been co-op, 41% have been condo, and only 1.7% have been townhouse. So that's the makeup of all the contracts signed since the reopen. It's interesting to look at it. The bottom line is it's all 3 million and under.
Right, 3 million and under. Although, so just in sort of my prior pre-COVID, you know, because including the second quarter, which is like 90% pre-COVID in terms of contracts and all that. The norm for the market under $5 million is about 70% of the transactions over the last year. It was, that's the last 4 quarters. It's about 70%. And you were saying 80 something percent, I think you were saying. So it just shows
90%, 89% under 3.
Yeah. So you can just see the pivot, right? Tremendous pivot.
And that's good to have the historical, because I did not have that, Jonathan. So I appreciate you coming up for relativity here.
Yeah.
Well, let's stick with you, Jonathan, and let's go back to the rental market now, because in many ways the rental market is sort of the more interesting story, because it just affects a larger part of the economy, sort of as I see it, versus the single family and co-op condo market. So, can you give us some quick insight into what's happening in the rental market / multifamily markets, and just what's the deal?
Sure. So, I think the big question for many people is, why, and Noah mentioned this earlier, like, why is the rental market more vulnerable than the purchase market, at least for the moment? We're seeing a lot more negative trends in the rental market than we are seeing in the purchase market as a general rule. And the primary reason for that is, if you sort of back up to the 30,000-foot view, is that unemployment is heavily skewed towards lower wage earners, and lower wage earners tend to be renters over purchasers. And as I said earlier, Manhattan's about 75% rental, with about a third of that 75 being open market sort of related. And Brooklyn is a little, when you put all the 5 boroughs in, it's about 2/3 of New York City is rental, which is very common. Most urban markets are more rental than owner. The reason why I bring that up is because over the last several years, we've had, the narrative for the rental market has been soft at the top and tighter as you move lower in price. That the growth rate for rents on smaller apartments have been much higher than the high end of the market. We had a little blip in the last 6 or 7 months with the mansion tax, making the high end rental market actually grow like the rest of the market, because would-be buyers of high end properties were sort of camping out in the rental market until they were comfortable. What's happened post-COVID in the rental market is that the low end, in fact, studios and 1 bedrooms, this is just a Manhattan number, studios and 1 bedrooms had their largest year-over-year decline in median rental price in 8 years. We're seeing a more softer sort of performance at the low end. Everything is softening, as a sort of generic brushstroke statement. But we've actually seen this sort of reversal in pattern. One of the reasons that sort of, besides the unemployment, is that the rental market, as I said earlier, is driving a lot of the outbound migration activity in the outlying suburbs, renters becoming first-time buyers. And the evidence of that is we just cracked, at least, according to the way we calculate it, the 5% vacancy rate. We're at 5.1%. And the reason why that's important is because for the last 14 years, it's been between 1.5% to 2.5%, 2.5 being a rare high. And then the last 4 months, we've, I don't know if they say this in the stock market parlance, Noah, but right now it's got a 5 handle, but it had a 4 handle last month and a 3 handle. So it was, 3%. And then it was 2. So literally the vacancy rate has more than doubled from the high end of the range of what was a very tight range for the last 14 years. On top of it, listing inventory has tripled over the last year and is just going up, straight up. Not only that, concessions, meaning the market share of concessions, the footprint of concessions in the rental market is, in Manhattan, it's the highest it's been, I believe, in 14 years as well. And so, and you look at last month, not this month, last month was the largest decline, year-over-year decline in median rent, net effective median rent in like 15 years or something along that line. So basically all the metrics are pretty terrible if you're a landlord. You know, that's from that orientation. However, it's also bringing in affordability, greater affordability, you know, into the market as well. So while so much focus has been on outbound migration, we're already seeing signs of, you know, this inbound pattern, you know, where people are coming in because it's, you know, a better deal. It's still, you know, disproportionately outbound.
Right. And I think a lot of that was sort of a self-inflicted wound, you know, for more than 14 years, 20 years plus, 30 years. I mean, you know, the name of the game was have your leases expire June, July, and August, and then re-rent them. And so we just had, by clockwork, you had an enormous amount of inventory hit the market and just keeps hitting the market. So that's sort of
right.
Yeah, and I'm wondering, John, where that vacancy rate's going to settle down. I mean, it sounds to me like it's. Whoop, I mean, it's just kind of in
Straight
the
up.
yeah, straight up. It could go to 8, 9, 10% during the cycle.
Yeah, I mean, there have been other, you know, what the legislature, they passed a bill, or they didn't pass a bill. They issued a couple of bills to address, because when the vacancy rate exceeds 5% in New York City, in theory, that eliminates rent stabilization.
right.
And so what, and my report at 5% is not the official number, but, you know, the numbers are, you know, some other numbers that have been reported by, you know, sort of official outlets have been far higher than mine. So they're postponing it for a year before they, you know,
Right.
vote. I'm sure that
They'll nix that whole thing.
Well, it reminds.
The 5% is a political number. Truly, it's not a technical number.
Yeah.
And you know,
Well, it reminds me.
established,
It reminds me of the Fed. They take out everything that's inflated, and they say there's no inflation. So it sort of works like that. All right, I'd like to shift now to the lightning round. I wish I had some fancy sound effects to you know, make some cool noises, but I don't. So we're just going to go 30-second quick answers. Jonathan, let's start with you. Based on current sales data and trends, has real estate in New York City bottomed out?
No, I don't think so. I think it's going to get a little weaker in the fall, because I did a study on this. People pull back, and then there's a massive release of pent-up demand November through February, and then it kind of comes out in the wash.
Interesting. Noah, what do you think?
No, not really. This is going to be multiple bottoms. We've already had one. There was the first bottom in June. We track monthly. So like if you look at it on a monthly basis, we're already starting to bounce off that month. But when I think about 1,700 COVID deals yet to file through, and I think about the next few months coming, I can't imagine us not bouncing back down. So I think we're going to retest that and have a couple of zigzags on the bottom and pull out of it later, end of the year, early 2021.
Yeah, I tend to agree. My take on this is I feel like we might not have seen the bottom in terms of price action, but I do feel like we've seen the bottom in terms of transaction volume. So I think transactions are going to increase, but prices might decrease. Who knows what's going on?
Completely
All right.
concur with that.
Yeah. Noah, new development discounts. What's going on? New development discounts.
Hard to track. You got to mention that every single development is its own unique situation with its own debt stack and construction terms and quality and sponsor health and all that stuff. But generally speaking, I think it's around 10 to 15% on sub $3 million products. That's in pricing. And then what you can get on concessions after that. If you're looking in the 5 to 10 million plus sector, you're probably closer to 20, 25% discounts.
All right, Jonathan, what do you think?
I'd actually, what I'd add to that, so that all sounds consistent with what I'm seeing. I'd also argue, and this is probably a bit too anecdotal to be credible, but just what I'm seeing preliminarily, it looks like the luxury sort of, you know, north of $4 or $5 million, that the new development space is actually outperforming the resale space in terms of contract activity.
Very interesting.
You know, both are bleak,
Going to
both
work,
are very weak, but it is sort of odd because we tend to write off new development. I certainly, you know, have said that for, you know, not write it off, but
look for bulk deals. Jonathan, look for bulk new dev distressed deals to happen in this cycle.
Well, you know, HFC, the debt's for sale now, so who knows how that's going to affect things. That's
just
breaking news from yesterday. All right, Jonathan, let's stay with you. Current market negotiability. What do you think? Just current rough market negotiability here.
I think, like I was saying before, I think it's 5 to 10%. That's what I mean by that is not what Noah was saying. I mean, if this apartment was on the market pre-COVID versus today, how much less will it go for, irregardless of what it's asking? That's what I think.
Right. Noah, current market negotiability?
I think they're around 7 to 10%. 7 to 10% with the outliers a little bit higher here and there, but those are hard to identify until you actually go and bid on them. And of course, those are probably priced too high to begin with.
I agree. Circle gets the square. Let's say here, what's the next one? This was a question that came up over and over again. Do I sell now or do I wait for next year? Noah, start with you.
I'm going to say wait. I'm going to say wait at this point in time. If you asked me a few months ago, I probably would have said list, but I'm going to say wait between the election, COVID, and a market that typically slows down around Thanksgiving. Wait until we're potentially rebounding, get away from the volatility over the next 4 to 6 months and look February, March.
All right, Jonathan, what do you think? Sell now or wait?
So my answer would be all the above. In other words, everybody's situation.
You can't do that, John. You can't triple stamp and double stamp, Jonathan.
I'm triple stamping all day long here because just because everybody's personal situation is different. I think Noah's talking from a straight investor standpoint. I've never believed in timing the markets, so I have no answer. I honestly don't know.
All right, so it's an abstain. I respect that. All right, well, let me ask you, put you on the spot now, Jonathan. When will the market start rising? If you don't want to time the market, can you time the market?
You're just chasing me down the rabbit hole here. I don't. So first of all, the big caveat, I know I have 20 seconds, is the COVID vaccine, because anything before that is almost meaningless. But I think after the COVID, and we hope it's in 2021. I think we're probably looking at 2022, 23. I think it's a ways out. Maybe more like 23. I think we have 2 or 3 years.
Noah, what do you think?
Well, again, if you look at it on a monthly basis, we're already rising from June. So it's a hard question, but that's not a trend that I think is going to sustain itself. I think it's going to be uber volatile over the next 4 to 6 months, up and down, up and down, up and down. Hard to find a trend from it. I do think we're going to start to see a formation of an uptrend again, either later this year, but probably more likely sometime in early Q1 of next year. I'm a little more hopeful, only because that's coming from depressed levels.
Right. And Jonathan, you think that we're not going to really see a trend until we get some sort of vaccine for the virus? Is that?
Yeah, I think that, I mean, look, we could, I'm not saying we wouldn't, but I think I'm talking about probability. And to me, probability is without a vaccine, there's no probability of anything, because we could have, listen, I know this is the long 20 seconds, but when we were in the heat of the outbreak in Manhattan, I got a call from an appraiser friend of mine in West Texas in the middle of nowhere saying, boy, you guys have it hard. We're so lucky out here. Everything's so spread out. 2 weeks later, West Texas is the next hotspot, right? So just because we've sort of licked COVID, schools haven't opened yet. What happens when they do? I just think it's a little soon, but maybe that's why I was never a day trader.
Well, let me keep you there, Jonathan. What do you think about foreign buyers? This was another question we got a whole bunch of people asking about. When do you think foreign buyers are going to come back to the city?
Well, a lot of that, it depends on 2 things: immigration policy, and which is, right now certainly there's an anti-immigration sentiment, in policy, and then on top of that, I think it's the currency play. I think the dollar is still too strong, compared to a lot of other currencies, to make it, a really obvious discount, which is really what drove, especially the euro. We're just nowhere near where we were before. So I think that's a while out. It's funny, in my 30 years, but it's a long 20 seconds. In my 30 plus years, it seems like the currency play phenomenon, it always happened like every 7 or 8 years. It's not like every couple of years. It's really every so often. It was in 06. We had it in 13, 14. We're kind of due now, but the world screwed up, maybe sooner than later.
Right. Noah, what do you think?
I like the play for foreign buyers. I think it's a good play. I mean, you got a market that's down, right? I mean, we're down close to 2000, as close to 2009 levels as we've been since that happened. Rates are low. You got a stock market that's been on a tear. So chances are maybe if they were invested there, they could lock in a lot of profits. And I was going to disagree with Jonathan on one note. I mean, the dollar's come down a little bit. I think that maybe the currency has gone in their favor over the last couple of months as the Fed kind of tries to stimulate asset prices. So I kind of think it's a great time for foreigners.
All right. Last question. I'm just gonna leave it at one word and with a question mark, and that's Brooklyn. All right. So Jonathan, tell us about Brooklyn in 30 seconds or less, please. Thank you.
Brooklyn continues to be an outlier. Its rental market is soft, but it's not as soft as the other boroughs. The purchase market is booming. It's not doing what Manhattan is doing. We've seen a massive surge in contracts over the last 3 months, well above year-ago levels. It'll continue to be the outlier.
All right, Noah, what do you think, Brooklyn?
Outperforming. Brooklyn's holding its own. Like I would agree with what Jonathan said. I think I'm seeing a slight dip in price per square foot trends over the very recent term, like July, August, just very recent relative. So I think they're starting to show a little bit of crack, but it's like 8-9%. Other than that, median sale price is holding its own. The townhouse market seems to be holding its own. And when I look at inventory versus pending sales, I like to look at that pulse, the market pulse on UrbanDigs. It's tight. It's way tighter than Manhattan right now.
All right.
And one important trivia point is that 1 out of every 4 Americans has an ancestor born in Brooklyn. Just wanted to share that.
I like that.
There you go.
Well, I think it's really amazing over the last decade or so, more than that, how instead of Manhattan being sort of the center of the New York City real estate universe in terms of everyone's mind, that now it's expanded to include Brooklyn. It's just many more options for people. I think that's just terrific.
Even more, to your point, I remember 3 or 4 years ago, I was speaking. I went to China for the Real Deal had this forum, and my wife and I were walking around Shanghai, and we saw dozens of people with like leather jackets that said Brooklyn on the back, or their shoes that said Brooklyn on the side. They didn't say Manhattan. It said like Paris, Rome, Brooklyn. And I thought, wow, it really is a global brand.
That's terrific. Well, first of all, I'd like to thank Jonathan Miller and Noah Rosenblatt, our panelists today, as we talked about New York City real estate 2020 and beyond. Thank you, everyone, for tuning in. As I said earlier, we're going to blast out some of the charts that Noah was talking about shortly. This will be on YouTube with the charts embedded in the video, if I can figure out how to do it. We'll see. And
we also talk about all these topics on our forum, John, on the UrbanDigs forum, all of this. Access to John, me, and Jonathan Miller, believe it or not. He will answer every single one of your questions.
Yeah, I'm gonna display Jonathan's personal cell phone on the screen here.
And his home address if you want to mail him something.
You guys are too good to me. I can't stand it.
All right. Well, thank you, everybody, for tuning in, and stay safe out there. Goodbye.
Thank you, everybody. Bye-bye.
Bye.